Okay. Hopefully that refresh helped with the audio and the video. Just want to make sure things look okay. Video sounds okay. So if you're having any issues, just let me know. I'm happy to refresh. I kind of refresh intermittently throughout throughout like the presentation, just because like I know it can kind of pop up. People have mentioned to me before that um, refreshing can just kind of help the stream. So I'll definitely refresh a couple times. If you're having issues with the audio, the video, just please let me know, and I'm happy to kind of help. But just usually like a refresh will do the trick. So if it's something more complicated than that, then we'll have to reach out to the tech team to kind of figure it out. But um, I'm just looking at Coop because they reported after hours. So just kind of like quickly, like I mentioned like a minute or two ago, these are all recorded and they're usually up on the YouTube. So T3's YouTube page, usually by the afternoon following when we get together. So typically by Tuesday afternoon at the latest. So um, if 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 in the future, like you can't make one of our option coaching sessions, or maybe if you show up late, or even if you just kind of want to like circle back and um, go through it, just maybe go over what we covered again. These are up on the website. They are at your disposal whenever it's convenient for you. So feel free to go over maybe anything over the past year since we started, or again like whatever suits you best, like time frame wise. I mean, like they're up there, so definitely. Um, if you feel like if you feel like you're running late one day, like don't rush. Like they'll be up there. You'll be able to like check them out, whatever works for you. All right. And just like another housekeeping thing, if you have any questions throughout tonight's session, just about anything we're talking about, no audio. Is the audio okay? Is the video okay? Just want to make sure everything's set before we get going. See if that helped. Any luck? Sorry. I just want to make sure. I want to make sure the audio is good. Wouldn't be beautiful, perfect. Okay, welcome. Yeah, that's what I was saying. Like I just like sometimes refreshing like the stream just fixes it. So that's why I'm just happy for the feedback. Just so I know if it's not working or not. Okay, beautiful, perfect. Okay, so just again, if you have any questions while we're going, please, don't hesitate to like ask, fire them off. I mean, like that's what these sessions are for. So if it's something maybe like not particularly related to like the topic at hand, that's fine. Maybe we can go over it at the end. But comments or questions, especially something like I'm talking about, like I tend to like get worked up and really get into it and start going. So I do go over some things a little bit quicker, and if you want, if there's something that maybe you have a question about, or you want to go over it a little bit longer, that's perfectly all right. Just shoot out the question, and I'll do my best to answer it. So please don't feel like you're interrupting. I mean, like I want these sessions to be as helpful, as useful as possible. So please, if you have any questions, like just don't hesitate. All right. Um, so I like to start with like the state of the market as usual, and basically we were just kind of humming along. Last week, light volume, holiday shortened week, and just kind of grinding, new high. And then today came back from the holiday, right? A lot of people were off Friday, so I feel like light volume, half day Friday, maybe not like a huge money moving session. People came back today, and we got hit, right? So first day of December, and also one of our worst down days in a little bit, so like a month really. And it's funny because I think like the last time we got together, we were talking about basically just how there really hasn't been much selling interest, right? I mean, like it's been kind of like a low volatility, low volume, grind higher. Really not much in terms of like trade headlines to really knock us lower. I wouldn't say like today, like it was like a trade headline specifically. We had some news like this morning about Trump was like raising tariffs on steel to Brazil, and maybe that hurt a little bit. I don't really know what triggered like the actual like pullback. To me, really like the most important thing is the 8 EMA. Okay, so like this 8 EMA, so it's this green line that to me remains the really like the most critical level that I want to focus on. Obviously, spiders broke below today, but it's been like really like the key support level throughout like the entire rally over the last month and a half. And yes, we did close underneath it today, but we haven't really broken substantially below it where I'd say, okay, now you really need to like change like your biases, right, and really start to like focus on like downside moves. I'd say that like tomorrow, maybe the day after, excuse me, definitely going to be important. And oh, someone went down the wrong pipe there. So tomorrow, day after, definitely going to be important. If we can't bounce to reset above that 8 EMA, then maybe you start to see like the selling snowball. Okay, like it's been an amazing move, and I really haven't had much of like a sustained drop. So if we do start to see some like heavier selling, some heavier volume, then I mean realistically, we could see a move like all the way down into like the mid 300s and still be fine. It could be a little bit quicker than people anticipate, just because I mean it's been such like an aggressive grind, and the volatility's been so low that once that volatility starts to pick up, people might start to kind of dump things a little bit quicker, especially because it's year end and there seems to be a lot of like FOMO market chasing going into the end of the year. But again, what I'm focused on is the 8 EMA, which we closed below today, and now underneath that it's going to be the 20-day. If we can maintain some sort of like composure above the 8 and the 20, I think like the trend remains intact. You're still focusing on bullish strategies, right? That's what I talk about in the letter. I mean, like my main focus is still bullish, but after like that 2 week ago move where we started to see like some selling come in, move back down to the 8 you made, then I wanted to even out like the mix of trade ideas from maybe like 80-20 bullish to bearish to now I want to be maybe more like 70-30, or even like maybe like like 60-40. So I really want to even out the mix. I want to get some more like bearish swing ideas in there, versus like for a while it was just like bullish nonstop. But now that you're starting to see some volatility come back, you're starting to see a little bit more two-way action. I really want to even out the mix on like the swing ideas. So you'll see more bearish trade ideas, more bearish trade setups. Really starting to try to like focus on like like again like evening out that mix, just because I don't want to be caught like too one-sided or too flat-footed if we do get a pullback and you really don't have any trades on there to capitalize. All right. Um, Kind of the same thing with the Qs. They basically violated the 8 EMA today, and actually, at one point they traded below the 20. So at the moment, the Qs showing a little bit more weakness than the spiders. And because tech is obviously so important and it leads, or it has been leading for such a long stretch, definitely something like I want to keep an eye on. I mean, if it does crack below the 20 day, again, I mean, like that's going to open up some downside, and we have like those hedges in place. So the spider January put hedge, the Q January put hedge, right? We even have like the UVXY January put call spread. So we have hedges in place, and basically what I like to do is to kind of like carry some sort of like longer term put hedge, and then if I feel like we're actually going to get some momentum lower, then I might like add to that hedge, or even like try some sort of like shorter term strategies just to try to like capitalize on a move lower. So that's why you'll notice like a lot of times I like to carry a little bit longer term put hedge, and then if it looks like we're gonna like crack, or really looks like we're about to like start to pull back, then I'll do something more aggressive and maybe go like shorter terms, maybe like weeklies, 2 weeks, maybe even like 3 weeks, like something like that, like some sort of like downside bearish contracts on like spiders or Qs, just to try to capitalize on like on a quicker move. Okay. So the IWM, I just wrote this up as like a trade idea, just like I mean today was like it was initiated, and even though it did get hit, it actually held where it needed to. So this is what I was looking at, and we talked about the IWM setup last time we got together. So obviously like a really big level of resistance, right? It's been stuck underneath like 158, 159, 160 since the beginning of October last year, and it powered through it last week. Volume was decent. Now it's pulled back and is back testing that 160 today specifically. Right? If you go to like the 30-minute, you can see rolled over and held 160 absolutely perfectly. So even though it was kind of like an ugly session for IWM, I mean, it got hit with the other averages, it actually was kind of constructive in the sense that it held exactly where it needed to, which is 160. I would prefer to see this bounce a little bit more aggressively tomorrow. So I'd like to see this maybe like firm up, maybe get back above 161, give a little bit of wiggle room. Because if this starts to lose 160, then it's, you're kind of in the position where it seems like you're kind of waffling whether if it's like a breakout failure or is it just a little bit of like a head fake. So as of right now, I still feel like the IWM setup looks good. It held today where it needed to, and overall, I mean, if this does start to like work its way higher and play catch up to like the S&P and the Q and the Dow, there's a lot of room, right? I mean, if it just gets back to its 52-week high or its high from last year, I mean that's basically like a 7.5% move, right? From like 160 to like 172. That's basically like a 7.5% move just to get back to its high from last year. So I like this idea, held where it needed to, but now we're gonna have to see how it responds tomorrow, the next day, because it would be better if this could start to kind of distance itself or maybe build a little bit of higher base versus like just hovering around 160, because then it kind of threatens that breakout failure, and we might have to keep like a little bit tighter of a stop on it. But overall, it wasn't like a good day because it pulled back, but there were some positives in like the kind of like the week session, and holding 160 was definitely, in my opinion, more on the positive side. All right. So oil still waiting. We talked about this last time too. I mean, it's still got like that really pretty pennant that it's forming. As you can see here. So it's still got like this really nice pennant that it's forming, but at the same time, it just can't quite go. It's had some good moves, right? Like it looked like it was going to go in September and failed, and then it looked like it was going to go last a couple weeks ago, and now it's like pulled back again. So, I feel like this has like a ton of potential, but it doesn't have any participation and doesn't really want to go. So I'm watching it. And we've started to put on some like some energy trade ideas. So like the Halliburton remains open. The Simrex, right? XEC we just opened. Like that's like another trade idea, and I think that looks pretty good. Let me get rid of this. So like I like some of like these the way like some of these energy names are shaping up. I don't like the overall commodity. I really like would prefer to see it act better, but no no. As long as it doesn't like significantly drop, then I don't think it'll impact some of these trades. But like you can see like XEC still acting good, right? Halliburton still acting good. So there's some leadership taking place in energy, and even though oil's kind of stuck in the mud, you know, I still think like some of these energy names are worth keeping an eye on. Gold. So we just rolled out gold and silver, and really like to me like the reason why I wanted to stick with the trade basically comes down more to like the weekly charts versus like the daily, because daily like they still haven't turned the corner, but from like a weekly perspective I still think like they have like a ton of potential. The volume profile was you can see it down here, so the volume profile was just so strong on like the breakout. I mean, yes, they haven't really been able to turn the corner and start to run back higher, but at the same time, like they're holding like these higher levels, right? So it's holding like this higher level, kind of consolidating, and it still seems like it has like room. So I really feel like there's potential to get up into like the low 150s if it can really start to build. Um, I kind of want to stick with the ideas as long as they really don't crack. They're not ripping higher. They're kind of like sideways ish. So that's why I wanted to like roll the trade out to buy a little bit more time, and before I really commit a lot more capital to like the calls or the call spreads, I want to see some better action. But you know, like December, obviously too short, really wasn't going to work. So push the bets out. Gold and like silver, kind of like the same thing. I think like this has a lot of potential. Like I still like silver a little bit better than gold, to be honest. And again, you can see like the volume profile, and you can see how much room silver could have if it really starts to turn the corner. So yeah, I like these ideas. I wanted to buy a little bit more time, so that's why I pushed the trade ideas out through January. If these things really start to pick up and start to turn the corner, okay. So if like silver can get back above like 1630, right? Get back above like the 50-day, get back above the 100-day, and maybe start making a move into like the high 16, 17 area. Then we can start to maybe like size into things again. Then maybe we can start putting on some like some bullish trade ideas and like maybe some of the metal miners, maybe like the PASS. I saw some bullish action in that. So I'm definitely like really focused on these still, but before I want to size in and really commit a lot more capital, I want to see like the action improve a little bit, because right now they're still kind of like treading water, not really like breaking down, but also not really turning the corner. So I want to stick with it, but I also want to see some better action before I really start to like commit a lot more money to it. Okay. Any questions? TLT, kind of an ugly day today. And so next week is the Fed meeting. So we're obviously we're gonna the next time we get together is gonna be 2 weeks from today. So it'll be after the Fed meeting. So FOMC rate decision next Wednesday. I just checked the Fed funds futures I before tonight, and it's about like a 95% chance that they stand pat. So basically, most people are expecting them not to move rates next week. I think it would be an upset if they did, or a surprise if they did. So, I don't know. It might be more of like a non-event FOMC meeting, but that is next week. And right now, TLT, it's not really here nor there. It had a pretty big bounce, but today it got hit a little bit harder. So, you know, but bonds to me are really only interesting if they have like a huge move. So if they have a huge move higher or a huge move lower, then I'm looking for a reversal. But when they're kind of like chopping around, treading water, not really like something I want to be involved with. But as we head into next week and the FOMC meeting, could be something to keep on the radar. Right now, it doesn't really look all that interesting from like a bullish or bearish perspective. So probably going to leave it alone. But again, 95% of traders are expecting Fed to kind of stand pat next week, not move rates. So if they do, that would be a surprise, and you might actually see kind of like a big move. So we'll see. But that's over a week off, and who knows? A lot can change in a week, especially in this market. Ah, any questions? No. It'll be interesting to see how we respond because even with like today's like uptick in volatility, the spider contracts really aren't seeing like their implied volatility really ramp. I mean, they're only pricing in about like a 325 to 350 for the remainder of the week. So, I mean, today top to bottom, right? We moved about $3.50. So, like one, like excuse me, 314.50 to like 311 ish. So we moved about 3.5 points today. Like that was the spider's travel range. The spider straddle for the remainder of the week. So through Friday expiration, it's only priced in 3.5 points. So basically, just what it moved today. So you can see like the implied volatility is not really like ramping too much on the spiders, even though like the volatility is starting to like tick up a little bit. So that's definitely going to be something to keep an eye on. Um, if I start to see some like giant priced in moves like on like a 2 day or 3 day contracts on the spiders, then that's really going to be a signal for me that people are really starting to get nervous. The volatility could really start to expand, and then that's when you really want. I feel like that's when I want to like start cleaning up like a lot of like positions that maybe are like you know either like multiple rolls or maybe like they're really like kind of like hanging on by a thread. Um, so, but right now I'm not seeing that, but I'm keeping an eye on it. Okay. So if there's no questions, then what we'll do is we'll hop into to today's lesson, which uh, is about stock replacement. So, um, kind of interesting. You know, maybe you're familiar with it, maybe you're not. It's I feel like this is something that to me it kind of gets more it kind of gets more attention maybe at the end of the year or after like a big move. So specifically like a big move higher. All right. It's oops. It's really like it's not it's not an active trading strategy, okay? So it's not something that like a day trader necessarily would be focused on. This is more so maybe a trader that has multiple positions. Maybe like this is for a less active trader, somebody that kind of sits in like a bunch of like stock and only trades options, maybe a little bit less frequently. I'd say that's kind of how I would think like stock replacement kind of fits into like the playbook for traders. And really like at its like most basic, it, it's all about transferring risk. All right. So it's not necessarily like it's not assuming more risk or really like it's not like most trading strategies are about taking on risk to maybe like go after like a bigger return, right? But this kind of falls into the category more of like a covered call, some more like defensive strategies where you're basically looking to like shift like the risk profile from like your stock or equity position into an option position, all right? And again, like this is something that I find gets more attention around like the end of the year maybe or maybe even like after like big move higher. So I think like you heard people talk about it maybe in like March and April of this year after like the spiders and the averages. It had like a really big bounce from the December low. So it was like a nice 4 or 5 month run, and people were saying maybe it's like a good time to kind of like transfer risk. So you actually saw it in the option market. You saw some big like stock replacements and like some big names. So it's kind of after like a long run or maybe towards like year end. Also, this is something that's going to like pop up around like maybe some significant catalyst, okay? Because it's kind of like a risk reduction strategy. So if you have like a major event that could potentially move the stock a ton, this is also something that you'll see. All right. So it's pretty straightforward. So I'll just kind of like talk through like the general idea, and then we'll go over like an example. But basically, stock replacement, right? Trader is going to close their stock, right? So they're sitting in stock. So that's how it starts out. Like you're sitting in a stock position. So you're going to close the stock position, and then you're going to substitute that position with deep in the money calls. Okay. So theoretically, like you could do this on the bear side, but I feel like 95% of people kind of use this on the bull side. So I'm just going to talk about the bull side tonight. So again, you're basically just closing your stock equity position, and you are opening deep in the money call position. All right. Now, this is going to lower your overall capital commitment. Okay, which again I'll go over an example. You see what I mean, and it's also going to allow you to stick with the idea, right? So it's like you maybe you're a little bit uncertain. Maybe you think like the stock could pull back, or if there's a big catalyst, maybe you think the stock could have a big drop. So it's basically like moving the risk to options, lowering the overall capital commitment, but still being able to like stick with the idea. All right. So it kind of gives you a little bit more flexibility, while also kind of lowering the risk profile. All right. So kind of straightforward, like the basic idea, straightforward, but selecting the contracts is really going to be the most important aspect of this. All right. There's really like three main factors that you need to focus on when you're picking the contracts for rolling. All right. And the first thing is probably the most obvious one, and it's just the number of contracts, right? So you basically want that option position to mirror the stock position, right? So if you have you know 200 shares of a stock, then you want the options to be the equivalent of 200 shares. So you need two calls, right? So it's basically like going after the number of contracts that is like the share equivalent of options. Okay. Sometimes you're going to have odd shares of stock, and then you're going to have more of a decision to make. So do you want to round up or do you want to round down? Because obviously options are only offered in 100 share increments, right? So you can only buy like one call. You can't do a fraction of a call or a fraction of a put. So if you have like 250 shares, then you're going to have to figure out whether you want to increase the exposure to go up and buy three calls, or if you want to like decrease and go down to two calls. So that's the first important thing to factor in when you're kind of going with like the contracts. Second, also very important, the delta of the options. All right. One is the highest possible delta, and -1 is the lowest possible delta. So one delta means that the options are going to move one for one with every movement in the stock, right? So for every like $1 of stock gains, the option will gain $1, right? So if that's like a 1 on the delta, that's what it means. It's going to move perfectly in tandem with the stock. Okay. So again, if you're creating an option position that you want to mirror the stock, then it's going to be important to get an option position with high delta, right? Because you want that option position to be as close to the stock or act similar to the stock as possible, right? So for me personally, I really wouldn't want I wouldn't want a stock replacement to be lower than an zero point 0.8 delta. Okay. Um, Some people may have a different opinion. Some people may have like a different way they approach it. Me personally, I wouldn't want less than zero point 0.8. So because of that, then I'm gonna have to go further into the money, which is what you'll see when I kind of show you like an option chain to get like that to get like those really high delta contracts. You got to go really deep into the money. Okay, versus like typical trades, like a lot of the trade ideas we do are out of the money, right? So they're going to be a lower delta, or at the money, which are going to be a little bit higher than out of the money, but still not like you're not going to see an at the money contract with like a zero point 0.8 delta or anything like that. So to get like those really high delta readings, you're going to have to go really deep into the money on the call side. Okay. And the third and also significant too is expiration. Okay. Now, each trade is going to be a little bit different, and the nature of the trade or the reason why you're in the trade is going to impact what the time frame is. But generally speaking, I want probably 3 to 4 months minimum for stock replacement. Okay, like just for like a normal swing idea, 3 to 4 months minimum. All right. If it's a catalyst trade, so like an earnings or event, then that's a different story because then you have really like a date in mind when the stock could potentially have a significant move. So then you can possibly do the stock replacement only through or maybe just till right after that event or that catalyst. Okay. So more often than not, though, stock replacement 3, 4+ months. If it's if you're doing the stock replacement because of a catalyst, then you can go shorter, but you want to make sure that you line it up with the date of that catalyst. All right. And what you'll notice is that if like the further in the money you go, so if you're buying like deep in the money calls, going for like delta of like 0.9, 0.95, etc., then the option value, so like the price of that option is basically all intrinsic value, right? So you're really only paying like a marginal extra amount of time value because the option is so deep in the money. So you'll see that when I show you an option chain that like going the difference between going deep in the money calls 3 months out and going deep in the money calls 6 months out. Um, while it would seem like a lot, it's actually not because the options are so far in the money that you're really not paying a lot in time value. Okay, so let's go over an example, and I did this. I did this before the open, so Apple actually pulled back a little bit today, but the general idea stands. So let's say, for example, that you have 200 shares of Apple and you want to do a stock replacement, right? Like Apple's had a monster run in the last 2 months, and you want to do a stock replacement because you think maybe Apple's susceptible to a pullback, or maybe you have a lot of money committed to Apple and you want to put it elsewhere, right? So you want to do a stock replacement. So let's just say Apple's trading at 267.50, right? And you have 200 shares. So I was looking at the option chains this morning, and the April 17th 220 call. So that's 47.5 points in the money. Okay, and that basically goes out 4+ months, right? So 47.5 points in the money, 4+ months in time. So it's actually closer to like five. Trading for about $50. Okay, and you can see here delta of about zero point 0.9, 0.92, almost 0.93. Okay, so you can see that the option, right, is trading for 50, yet the stock is 47.5 points in the money, right? So basically, what, like 95% of that option value is intrinsic, and only about 5% of that option value is time premium, right? Now, going out like an extra like 2 months on top of that, going out through June. Okay, so again, same call, right? So the 220 call for June, 47.5 points of the money is trading for 52.50. Okay, but you can see the delta is a little bit lower, so it's only about 0.89. But again, the option is 47.5 points in the money and is trading for 52.50. So in this case, you're about 90% of the value of that option is intrinsic and only about 10% is time. So you can see that like the further in the money you go, like time is only the time value is only going to be like a smaller component of the option pricing. So when you want to go out longer term, the further in the money you go, it's actually you can kind of get better deals because you're really not paying like a ton in time value. All right. So now, in this example, like you just need to like determine like what time frame you want. But again, like I said, like I want at minimum a contract that's zero point 0.8 delta or higher, preferably better. So if you went with say like the April 220 call, right, trading for $50, what you would do is you would sell the 200 shares of Apple stock, and you would buy two of the April 220 calls, right? So then basically now you have you've executed the stock replacement, and now you have bullish exposure to Apple through April expiration with those really deep in the money calls. Okay. So what's the benefit, right? So like why would people want to do this? Okay. And again, the main goal is really like capital reducing your capital commitment, all right? Or net risk. It's another way to look at it. Um, but at the same time, you can kind of stick with the exposure to the underlying stock, okay? So you're worried that there might be a pullback. You're worried that a big event is coming and it could really get hit hard. Or like, in case of Apple, maybe Apple was like a significant portion of the capital in your portfolio, and you're starting to get worried that it was just kind of like dominating everything else, and you wanted to like maybe like reduce the dependence on that one position, right? Maybe diversify away from it, but you still want to participate in any potential upside on Apple, right? So that's one of the reasons why people would execute a stock replacement. And freeing up that capital, now you got things you can do with it, right? So again, you can diversify. Maybe you want to put it in like another trade idea. Maybe you want to increase the leverage, right? Like you could even like if you roll out of that position and you get that extra capital, maybe you could even like, instead of buying in the previous example where it was like 200 shares to 2 calls, maybe you could do the 200 shares close and you could buy 4 calls. So you're increasing your leverage, right? Also, another reason why traders will want to open up or free up the capital is because then they could use that to finance a hedge, right? So specifically, if they're worried about a pullback or an event that could drive it lower, then they could do the stock replacement, get the extra capital, then use some of that capital to pick up like a put position or put hedge or some sort of like hedge position to either like capitalize on that downside move or maybe protect against like a move lower. All right. So you'll see what I mean. So like Apple, right? So selling those 200 shares at 267.50, right? Like the total capital, so like the total proceeds from the sale. So if you were to sell 200 shares at 267.50, that'd be total net capital of 53,500. Okay. Now again, if you bought those April 220 calls, right? They were $50 each, and you bought 2 of them, then that's 10,000, right? So what you can see is that you're basically maintaining the upside exposure, right? Those contracts have like a 0.93 delta, right? They have 4+ months until expiration. But what you're doing is you're opening up your capital that you have at your disposal, right? Because you sold the 200 shares, you collected 53,500, and then you laid out 10,000 to buy the call. So now you have 43,500 extra capital at your disposal, right? And what's interesting about this is that, right? So like if Apple were to have like a big drop, right? Then the max you could lose on your 220 calls is only 10,000, right? Versus like if Apple were to drop below 200, like say something really nasty came out and it dropped below 200, then you would actually lose more, right? So you'd lose almost 14,000, right? If Apple dropped below 200, like the 200 shares would lose about 14, whereas the 220 strike calls would only lose 10, right? It'd be like the premium you paid. Okay, just kind of see what I mean there. I know uh, it's pretty simple. It's pretty straightforward, but again, like it's kind of just like looking at it, kind of understanding why people do it, right? So it's I'm sure it's something maybe have heard about or maybe you're familiar with, but again, it's something like when you really get into the numbers, it kind of shows you why people are interested in doing this. All right. So I talked about why people want to do it. I talked about the benefit of doing it, but now I'm going to talk about the drawbacks or the downside to doing it. Okay. Um, Dividends. Apple, not a huge dividend, but some stocks pay a pretty substantial dividend. Okay. Like maybe you get like a 3, 4, 5% dividend in some of these stocks. So if you're in the stock, you collect a dividend. If you're in the options, you don't. Okay. You're not entitled to an option. If you're an option holder, you're not entitled to collecting the dividend. So that could be like a serious no-no for some people because a lot of like their strategy revolves around dividend stocks. So definitely something to weigh when you're thinking about stock replacement. Also, expiration, right? Like if the expiration is either shorter or maybe like the stock gets hit very, very, very hard quickly and then your contracts expire worthless, right? Then you have zero exposure to that stock. And maybe like a year down the road, positive news come out or maybe the thing rebounds and it goes back up where so if you're in the actual stock, you can participate in that rebound, but because you did the stock replacement, your contract's expired and you have no exposure. Okay, so that's definitely something to consider too, and that's why I say like 3, 4+ months. Like, I mean, generally speaking, if it's like just like a swing idea, I prefer longer versus shorter because this is like one of like the main drawdowns or one of the main negatives with this strategy is that you run the risk of the stock having a big pullback, the options expire, and then it rebounds. And whereas if you were in the stock, you could participate in the rebound, but because you're in the options that expired, you have no exposure in the area. Okay? Make sense? Any questions there? So just like quickly. So there's a lot of biotech catalysts coming up, right? So I've talked about it a lot. I actually did a video just talking about like how December is going to be such like a crazy month for biotech catalysts, and in this case, like this is where stock replacement could really make sense, like for like event trading, right? Or like you know biotech data readout, right? So like Sage, okay, this is going to have pivotal phase 3 data, and what I've read is that some people expect Sage to be down like 50% plus if the data disappoints. So it's a $150 stock, give or take, and a 50% move would be $75, right? I've read some people think that this could be down 100 points if data disappoints. So viewing it from that perspective, right? Like if you're looking if you're sitting in the stock, right, and you think that there's a possibility that like the stock could be down like 75 to 100 points if it disappoints, then you're probably a little bit nervous. You're saying like how can I reduce risk, right? And one of the ways is with stock replacement. So stock is at 152.20, right? So let's just say 150. I'm looking at the 100 strike calls on Sage right now are trading. So like the December 20th 100 strike calls are trading for about $57. So if you were to buy that, so if you were if you were to want to execute a stock replacement, right, you could buy like a very deep in the money 100 strike call for $57, and the stock is 52 152.20, 152.50. So basically, you're only paying like about $5 in time value because it's 52 and change points in the money. So the option call is 57. The stock is 150. Is 52 and a half in the money. Okay. Now, yes, if it's still going to be painful if the data disappoints, right? Because if it drops down to 75 or even drops down to 50, right? Like say it gets hit like 100 points, like some people expect, then that option is going to be worthless, right? It's going to be a zero, and you're going to lose like the $57 that you laid out for it. But if you were in the stock, then you would lose. Then you would lose 100 points. Okay, so you'd be down 100 points versus the options are only down 57 points. So that's why like there's really a lot of application for stock replacement, and like sometimes on these events it can actually make a lot of sense because the downside risk, especially if you anticipate it could be in like the order of magnitude of like 30, 40, 50, 60, 70% downside, then doing like these deep in the money stock replacement option strategies could actually reduce your risk profile, right? Because in this case, if you did like that strategy, right, max you could lose is the 57 points versus if you're in the stock and it dropped 100, then you're losing 100 points, right? So it basically chops your downside almost in half. So like the money at risk in the trade almost in half. So I just wanted to highlight this one just because you're probably wondering like what's like an event that people would do this, and this is like an example. Okay. Speaking of which, kind of want to go over. Um, so I've I'm sure you've seen it in like the letters. Like I've really tried to like hammer home the point over like the last week and a half. And bios have been absolutely rocking, and some of these names just have these huge catalysts coming up, and they've just been on these crazy runs. So AUPH, right? I mean, like this thing is up almost 50%, or I guess it actually was almost 50% in about 2 weeks, right? Stock went from like 5 to almost 8 in 2 weeks. So it just had like a huge move, and luckily we had the options open and were able to be involved before it had like this kind of like parabolic run. But you gotta like you gotta like weigh like the benefit now, right? Like yes, you could maybe roll the dice and stick with the idea and say like you got like a good entrance, like why would you want to like mess around with it? Like just like stick with the idea because like the trade thesis still stands. It's like yes, but at the same time, like like the overall strategy is up like 150 to 200%. So it's like even if like the overall thesis still stands, when it gets to like those really like significant profit targets, so like 100%, 200% returns, 300% returns, like it just makes sense to try to scale back risk when possible. Okay, so AUPH, right? Like I'm really trying to like drive home the idea that yes, like you want to be involved because it's still a lot of potential, and this thing could still have like a huge move, but it's also had like a really big run. The options are up a ton, and it makes sense to like take some money off and maybe like chop risk when possible, right? So that's why like today, like I said, rolling up to like the 11 strike call for January is probably a smart idea because it's like it's had a huge move. Like those 8 strike calls tripled, and now it's more about like trying to come out ahead, even if it goes up or down at this point. All right. Same thing with Axum. I mean, look at the run this thing's had. It's been absolutely crazy, and it's like another one. Like it's like we were in the options early, and now it's had like this epic run, and like the contracts have absolutely exploded. So it's like yes, like the overall reason for being in this trade still stands. Like they actually haven't released any of the data yet. None of the catalysts have actually played out. But at the same time, like the stock is up basically what? The stock is up 40%, give or take. Actually, it's up more than that. It's up 50% in like a week and a half to 2 weeks. So it's like even if like all of like the reasons for being involved in the trade are still there, it still makes sense to be like scaling back risk because the options are up like 100, 150, 200%, and if you can like kind of manage your risk ahead of the events, then it puts you in a better position in case like maybe like it doesn't have like a big move, or maybe like it flops, or like there could be so many things that go wrong that it still makes sense to try to scale back risk when possible. So like that's why like I'm really trying to drive home and like these nightly letters, like the idea of like really trying to like manage risk ahead of these events, because yes, like there's still going to be some really crazy moves coming, but they've already had some really crazy moves and the options have absolutely rocketed higher. So if you can take off money, if you can take off some size, if you can reduce risk, I just really feel like it's like a smart idea. Okay. I mean, Wave too. It hasn't. So this WVE, it hasn't even had that big of a move from like a stock percentage point of view, but the options have absolutely exploded, right? And I guess part of the reason probably has to do with the fact that bios are just ripping and everybody wants to be involved now in the catalyst, but the premiums have just gotten absolutely like jacked through the roof. So like I've been watching this one, and like I'm really hoping they open up higher strikes, because right now all they have offered is the 45. So it's kind of tough to like roll this up to like a higher strike because you're not really reducing your overall debit by that much. So I'm really trying to focus on like a way to reduce like the risk on this one. But again, you know, if these are names that you got into for the trade ideas, like those trade ideas still stand, but the options are up just so much that it really makes sense to like scale back risk. Like it's like takeoff size. Maybe like you're a little bit more risk averse in general. So like maybe you even want to like just take them off before the catalyst. Like I know it's like the thesis and the reason for being involved is still there, but when you have these type of gains ahead of like a major event, like it just makes the most sense to me to scale back risk if possible. Okay. So, I wanted to like kind of just reiterate that fact just because it's just been some absolutely amazing moves. The options are exploding. The implied volatility on a lot of these stocks is just like, like the 150, 200, 300 percentile range. So they're pricing in just these huge moves, and we may end up seeing it. Maybe we won't, and that's why I think if you can like cut risk, lock in money, I think that's a really smart plan. Okay. And also, what I want to talk about, I guess I got some questions just towards the end of the day on the VTF about my opinion on some of like these software reports coming up, and Coop reported after the close today, and um, it, you know, I I really a lot of these names to me, when you have like these, when you have these weeks when there's like a huge clustering of kind of like similar setups and like similar sectors, I put a lot of emphasis on like momentum or like the early names. Okay, and what I mean by that is not like whether it's like up or down momentum, whether it's like bullish or bearish, where that does factor in, but like that's not what I'm most concerned about. To me, like I want to see like if they're rewarding the options, right? Are they rewarding the risk taken for those events? And as much as software names have been better over the last 2 3 weeks, right? There's been some really great action. These stocks have been like beat up and they started to bounce. There've been some like great rebounds, some great reversals. So as much as the action's been better over the last 2 to 3 weeks, I still haven't really been seeing these specific type of trades really get rewarded on earnings. There have been some, right? So, like for instance, like Splunk, I think it was priced in at about 10. I think it ended up moving about 13. So that was definitely one that stood out. So it wasn't like a huge move on top of what it was pricing in about 10. Priced in 10, move 13. Not a huge move, but it was something, right? Palo Alto, I guess, was one maybe you want to say had a huge move, but obviously that was to the downside, right? It was priced in, I believe, about 15 to 16, and it moved closer to 30. So that certainly was one that stood out as like being rewarded for the risk. But generally speaking, like VMW weren't really rewarded. Viva weren't really rewarded. Autodesk, right, weren't really rewarded. And these were some of the more recent ones. So like that's why like Coop, I wanted to leave alone. Tomorrow you have Workday, Salesforce, Zscaler. To be honest, I might leave all of them alone. I want to see these patterns and like these stocks start to move more than the expected amount. Like I want to see that risk start to get rewarded before I really start to lay out the money for like the setups. Okay, there are some that I'm watching this week that I might trade regardless. So like Slack, I think this is kind of like a particularly interesting setup just because it's really like pushing up into the top of the downtrend, right? So this to me seems interesting. So you can see what I mean. So just drawing like some quick lines, you can see what I mean. Like it looks interesting. Option pricing not too bad. It's like 3.25. Okay. So like this is one that is a little bit different. Like this is one I might focus on, but that you have a lot that are kind of similar, like Okta, like Coop, Zscaler, Zoom. So there's a lot of names that kind of I'm gonna lump together and I'm going to be more in like the wait and see. Again, like I I would love to be involved, and like I would love to see like Coop be up like 20 points tomorrow, and Zscaler be that like up 10 or down 10 the next day. All right, like I want to see the volatility really start to increase, but I also I don't want to lay out the money without seeing some sort of sign that you're getting rewarded for the risk. Okay, because the last 2 to 3 quarters, these things have really been very challenging around earnings, and as much as like the action started to improve over the last 2 to 3 weeks, I'm still not seeing the signs on the actual earnings reports for me to like warrant laying out the money. Okay, so I will change real quick, and I will start to write up the trade ideas if I start to see some really crazy moves in this space on earnings. But for right now, like you know, don't be surprised if I don't really write up the trade ideas for earnings on these names, just because like I'm not seeing the reason, or I'm not seeing the rationale, right? Like if the patterns aren't getting rewarded, right? If bullish numbers aren't leading to moves higher, and like misses aren't really getting dumped very aggressively, then I just don't think it's worth taking the risk. Okay, so if you're wondering why I might be avoiding software stocks on earnings this week, that's why. It's because I want to see the risk, so like the money we lay out, I want to see the reward be worth it. I want to see like big moves to really like pay those strategies before I start like really sizing up, or laying out the money to get involved in those. But work, definitely one that I think is interesting, and even maybe like CrowdStrike too. I feel like this is one that even though it's kind of been lumped in like those high growth, high Momo stocks, um, options are a little bit on the high side. I still think this is one that maybe still could see like 10 points. So like work and CRWD, so CrowdStrike. Those are two that I might still focus on. Any questions? Just cover a lot there. I do. I do those earnings on the radar videos on Friday. So you kind of get like an idea of like my thinking, like what I'm looking at. Um, and I try to cover as many of like the big names as possible, and really like most of the ones I'm looking at. So if you're ever wondering, like if it's a kind of like a busy week of earnings and you're wondering why like you're not seeing like a lot of earnings trade ideas, um, there's usually a reason for that. And if you check out like those earnings on the radar videos, it kind of gives you an idea of my thinking. I try to be as like as like just straightforward and like open with what my logic is, and like behind like the trade ideas. So um, if you're wondering like why aren't there more earnings ideas when it's kind of like a busy earnings week, you can either check that out, or even if you want to like reach out and just say like, oh, what are your thoughts on this? Like I really don't mind, like I could help if possible, like maybe just like respond, just give you my quick thoughts on something. However I can help, basically. All right. Um, okay. Well, if there's I guess if there's no questions, maybe this is a good place to wrap it up for the evening. What do you think? That work? Okay. So, um, like I said, I'm watching a lot of these software stocks. Not sure I'm necessarily going to play them. Um, really like a main focus of mine this week, next week, the next couple weeks through the end of the year is going to be bios, just because it's such like a huge lineup of data. So if you see me talk about bios, you see me write about bios, it's just because we're kind of setting up for kind of like a busy stretch in biotech land, and the action has been phenomenal. So I'm hoping like that continues, and I'm hoping that translates to some epically wild swings on these drug releases, these data releases. So bio is definitely a focus. Going to be watching software. Going to kind of see how things develop, but kind of a busy week of earnings, even though we're kind of closer to the end of earnings season. And actually, next week there's some interesting ones too. So definitely be sure to like check out Friday's video, because you got some bigger names next week, like Costco, Lululemon, Oracle's next week, Chewy's is next week, Adobe, Broadcom. So you got some big names next week. Even though we're getting towards like the holiday season and things are kind of winding down for 2019, still plenty of like big names that haven't reported. So still pretty busy lineup on that front. Okay, cool. Well, thanks for hanging out tonight. Thanks for sticking around. Um, Hope you guys have a fantastic week of trading. And as always, like if you have any questions in between now and like the next time we get together, I love to hear from you. So please don't hesitate to reach out. Like anything that I can help with, I'd love to. Whether it's like a trade idea, maybe like an option specific idea. Like that's really like what these sessions are designed for, and like that's it's not an inconvenience by any means for me. I really like love to just talk trading, and I really like I'm so passionate about it. So like if you have any questions and you want to go over something like or want to bounce an idea off me, please don't hesitate to reach out. Yeah. So just follow up with like you can either like reach out to the content team, Island Trader. So like your contact at T3, and like they can like forward all the emails to me. That's probably like the best way, because like once they get it, they just pass it along, and then like I respond. Just otherwise I have to go through compliance. But yeah, like if it's like a trade idea or an option idea, or maybe something from like the letter or education, whatever. And like it's I'm here to help, and like I'm happy to help, and like if I can answer it, I totally will. So please, yeah, don't hesitate to reach out. Anything, I mean it. Okay, cool. Well, again, thanks for sticking around tonight. And I know a lot of you guys are watch these on recording, so after the fact, if you have any like questions, just shoot me an email, or reach out to me. If you have anything that you want me to cover in videos during the week, like so on like those YouTube or Facebook videos, happy happy to like take any suggestions. So again, just shoot me an email, shoot me a message, and I'll do what I can to help. Okay. So have a fantastic week of trading. Let's hope for some good moves this week. Let's hope for some good bio moves over the next couple months, or over the next month. And yeah, let's make some money. All right. So have a wonderful night, and I'll talk to you soon. Thanks, Island Trader. You too. Have a great night. Take care.